G'day, Matt Heath.
G'day, G-Lane. How are you?
Good, thanks. Welcome along to our ACC Guide to series. And
Great to be here.
We are tackling property investment.
Yep, we've already tackled two parts of this.
We have the kind of basics to it because we're here to answer the questions ask the stupid questions.
Yeah.
So you don't have to.
Yeah.
Of the experts we've got in from Staircase. EP 1, I think we just covered just the basics of property investment, and EP 2 was around the finance and how you can use the equity in your own home, because you're probably like me, I just try and spend my time dangerously trying to pay down my mortgage and don't think of anything else.
Yeah.
And in reality, it's actually quite valuable.
Yeah, I spend a lot of my time thinking about thinking about paying down my mortgage and then, taking European trips. But yeah, no, I get what you're saying.
That's right. So in EP 3, we're looking at kind of where to buy, the right location and property in New Zealand, where to buy, what to buy, and something that we probably need to look closer at in our lives in general, and that is due diligence.
Yeah, due diligence.
Yeah.
I think, not only in this area, I want to bring more due diligence to my entire life.
Yeah. I mean, probably good be practice, wouldn't it?
Yeah,
good practice.
with your relationships.
Yes.
Yeah, it's always good to do due diligence with the partner.
You sit down the partner in the first couple of weeks.
Ask some serious quick structural integrity questions and the like.
Yeah, financial questions. Get a limb report.
Get a full inspection. Get a builder's inspection.
Okay.
Check your teeth.
Well, I'm not sure. I'm sure we'll get into that in the housing side of it. But here we go. Let's get into our third ep here of the ACC Guide to.
The Alternative Commentary Collective presents The Alternative Guide to everything you need to know about everything you should know about.
Right, first of all, welcome back into the studio, Liam and Kieran. G'day, fellas.
G'day, nice to see you.
G'day.
Yeah, well, let's get into it, because we just gave a quick intro on what we're going to cover today, because we covered the basics in the first two eps. Matt, Heath and I think we've got our heads around it.
Yep.
But still some other questions.
I think we both discovered that we're supposed to discover that we had some equity.
Yeah. Yeah, we've both got equity and we should probably use it and let it sitting there. So we're going to get straight into it. So we discussed kind of a little bit, I think, the last few episodes around new builds over kind of an old villa, like Matt Heath did.
Bungalow.
Bad experience. Bungalow? What's the difference between a bungalow and a villa?
Yeah, they'll take a while.
Let's not get into
the weeds.
It's
about finials and, it's not huge.
Okay, but how do you actually figure out the best place to invest or buy in New Zealand? Well, how do you guys figure that out?
Yeah, well,
Liam?
it's I think with a lot of today's episode, we'll probably tap back into maybe school when you went through economics. I don't know how you guys were at school or you had economics at your class, but there was a few concepts there that you would have learned maybe about demand and supply. So, if we look at demand, for example, and looking for where to buy the right property, often we're looking for where are people moving to, where are the jobs being created, and what infrastructure is being spent by the local and broader government, because ultimately what that does is that drives demand, that pushes prices up. So if you're a property investor, that's generally a pretty good thing. So
right. So is it generally Auckland then?
Yeah, well, see, within Auckland, you've got, Auckland tends to be our powerhouse, right? That's where a lot of those main fundamentals of growth of population and infrastructure and stuff happen. So it tends to be that powerhouse, and within there's different areas within Auckland. If you move out of Auckland, then you're starting to look at areas we might get a little bit more property in the type or a little bit different yield. So it's really about balancing what you guys are sort of after. But the good thing is, if you're at this point looking at property, we kind of know what you can spend really, and we can start to go down that pathway.
Well, G-Lane's from Hamilton. Should he go back?
Yeah. I feel like it's better value down there. But what you're saying is, probably better value, but your yield's probably not as good.
Yeah, well, funny you said that.
Is that right?
Well, Hamilton actually is one of the fastest growing cities in New Zealand, actually.
Yeah, shove that, Matt Heath. He didn't mention Dunedin.
Dunedin is going places.
Yeah, it's been, Matt Heath.
So, Hamilton does get a bad rep at times, but no, it is, it's one of those occasions that does, you think of the old golden triangle between Auckland, Hamilton and Tauranga.
Yeah.
So, that's tapping into infrastructure there. Yeah. It is a location that does have a bit of growth heading towards it as well, so.
So you're saying don't discount the kind of smaller regionals. Don't discount. When you say smaller regionals, it's not.
Hamilton's.
Anything smaller than Auckland.
Yeah, when I was a kid growing up in Dunedin, I always heard people from Auckland slagging off Hamilton, and then I went to Hamilton. I was like, well, this is better than where I'm from. Like, what would they say about
Dunedin?
What would they say about where I'm from if they got a problem with Hamilton?
Yeah, well, I mean, the big thing to remember is, when you're buying real estate in these locations, your customers are your tenants.
Yeah.
So one of the big concerns we see from people is that they worry about not having a tenant because
Yeah.
that's your income.
Yes.
So, if you're looking at areas where these big cities, there are people that are going to tenant. You've got more options there, and that helps you as an investor in that side of it.
So of course, in the case we're talking about, it's not so important whether you want to live there; it's whether there are people that want to live there.
Yeah,
Yeah.
spot on. Yeah.
Right. So you automatically, in my head, I'd say Queenstown, because they tend to have, because there's lots of seasonal workers there looking. Would that be a sensible way as a prospective property investor for you guys to look at?
Yeah, I mean, Queenstown, I heard Heath, you like you're a Central Otago fan. But,
Huge fan.
Yeah, I mean, Queenstown's fantastic as the locations that we typically focus on, Auckland, Tauranga and Queenstown, they tap into sort of lifestyle appeal.
Yeah.
So New Zealand's it's a brilliant country, and most of the time people will see Queenstown as the billboard. So that's where we see a lot of tourism flowing in. It's recognised as a place that has a shortage of rentals.
Yeah.
Just recently we actually saw Jetstar's opened up 660,000 seats across the Trans-Tasman, and that's led to a lot of flights those tourism leading into Queenstown. So that drives people there. You've also got the Overseas Investment Act for properties over $5 million. That's going to fuel all these Americans heading down to Queenstown, and that drives growth. That drives infrastructure. That drives people there, which is cool.
And Queenstown's, don't forget, is land and lake locked as well. So it's actually quite restrictive in the potential to have a lot of buildings there.
Right.
So it's got that scarcity factor as well.
Oh, nice. So you mentioned Hamilton there, and the fact that it is, a bit of a dark horse.
Yeah.
When it comes to that, how do you tell an area is about to grow in value, Kieran?
Well,
Can you?
Yeah, you can. About 20 years ago, I wrote a book called An Insider's Guide to Real Estate Hotspots.
Yeah.
So through the research for that book, I discovered the key elements that actually you need for an area to sort of pop in value. Comes down to basically the same things, which is infrastructure, especially like improved transport links, or a railway station, or a large shopping mall. That sort of infrastructure that really attracts people to the area, becomes a bit of a magnet.
Yeah.
Those are kind of the elements that you want to look for. Is the area growing? Has it got potential? What's the local government got planned for infrastructure improvement?
Yeah.
I mean, looking at Auckland, coming back to Auckland for a minute, we've got a bit of an issue with the water care services in Auckland. We all know, the pipes aren't big enough, and there's actually there's tens of billions of dollars that's going to be spent in the next 10 to 15 years to upgrade that infrastructure. Now, that alone actually allows for more properties to be built, more infrastructure to be added on top of that, because that's like a base layer of infrastructure.
Yeah.
So this is all very positive for, Auckland in particular at the moment. And Queenstown, of course, has got a huge amount of infrastructure planned as well.
What about migration and population growth? Do you look at that as well? Does that help?
That's really important, and Auckland is actually the major benefactor of net migration, because typically about 2/3 of the migrants arrive in Auckland, and they may not stay here, long term, but this is where they sort of settle. So initially, that's really an underlying sort of benefit for Auckland. And at the moment, you may be aware that net migration is really low, but it's cyclical.
Yeah.
So we're actually at that low point. It's not going to go down into negative from here. It's actually very low, but it's actually about to turn, and that alone indicates there's some potential upside for the property market, certainly in Auckland.
Right. Like Matt, do you chase capital value, or do you chase rental yield? Like, what's the utopia if you're a property investor there?
It really depends on your circumstances and what you want to achieve. So, some people will land bank. You need a lot of money to be able to do that, though. The entry point is quite high, therefore they're chasing capital growth.
Yeah.
But then that might cost you a lot of money to fund that along the way until eventually you can sort of capitalise on that, versus maybe investing in entry-level new build, which gives you a much better cash flow. Really you want to look at what's your desired outcome in the long term, and then that will give you some focus on what you should be actually looking at buying.
When it comes to investing, Is it risky to go, you're talking about the other areas that you could invest in and looking at the infrastructure and looking at the best possible place. Is it risky to invest outside what you know and where you are?
Absolutely, can be. I mean, you need to be a little bit wary of smaller centres that are like a one-horse town. I mean, one example at the moment is, we know in Tokoroa the mill is a major employer, and they're just laying off 140 people, which has a significant impact on probably that town's property market. And it's not just the 140 people that are going to lose their jobs. It's all of the ancillary services that were providing support to the mill as well.
Yeah.
So everything changes. That's the danger, or the volatility, should I say, of being in a small centre.
I think when you're trying to pick a property to buy real estate, it's kind of like your KiwiSaver. It doesn't necessarily have to be in your backyard. So you're generally your KiwiSaver is probably invested in different markets around the world to get the best return. So quite often it comes down to running the numbers, looking at the locations where they have those key fundamentals, so that you can steer the course for the long term, and that will drive it.
But that's the service staircase provide, though, eh? So we'll ask you guys, hey, this is my budget, where should I go? And you put some recommendations forward. Is that?
Yeah. Well, that's exactly. I mean, you go, hey, I've got $800K to spend. Now, where do you start?
Yeah.
So you need to bring it back to the basics. Start looking at different locations. Different locations will give you different property types, and then just comparing all of those, a balance of yield and capital growth is kind of what you're really
research the infrastructure potential for that area. Like, we do a lot of research on our locations. We're not.
Obvious. You're very infrastructure focused, Kieran.
Because that is a key driver for growth in properties as well as population.
Totally.
You should spend some time with Jeremy Wells.
Oh,
that guy loves infrastructure.
Yeah, he does.
Oh my God, he gets excited about infrastructure. He gets almost turned on by infrastructure.
So are investors still? Are they still buying in Auckland despite the prices being so much higher than everywhere else?
Absolutely. Because again, Auckland is the economic powerhouse of the country, and everyone knows that.
Yeah.
So the other thing is the point you just made about, prices being high. Do you think property in Auckland is relatively unaffordable today, or affordable, or where does it sit in your perception at the moment?
My perception is that Auckland is miles more expensive than anywhere else in the country. That's my perception.
Yeah, it's not actually miles more expensive, because, over the long term following the cycle, there's a gap in prices, like between Auckland and Wellington, for example.
Yeah.
That gap has actually closed to an extreme point that I haven't seen in the last 30 years, where prices are actually relatively close to Auckland prices, which doesn't quite seem to be justified. Maybe that's why Wellington's had a bigger hit in values compared to Auckland. So Auckland right now is actually in a sweet spot in respect of affordability. Like, affordability has improved so much, so rapidly in the last 6 to 12 months that most people don't realise how affordable those properties have become, to the point where a young couple on the minimum income each can actually buy a brand new townhouse, 2-bedroom townhouse, say in West Auckland, and afford to pay the mortgage right now. That's on the minimum wage. Now, if that's not affordable, what really is?
Yeah. According to Liam, I'm going to go to you. According to Staircase, and we just touched on it briefly, where are the best places in New Zealand to invest, according to your guys' research and what you'd advise?
I mean, we can't look past, we've sort of talked a fair bit about Auckland. I think if the strategy is long term, and you can start to look at, Auckland, the prices have come back. We're in an environment where interest rates are dropping. It taps into those fundamentally long term. That demand will drive it in the long term. So that migration will kick it off. There is, and I think within Auckland there are different regions that are growing in particular. In Queenstown, I've sort of highlighted that's got a lot going for it. In terms of jobs for Queenstown, you've got a huge film studio that's being built down there.
Yeah.
So there's jobs being created. We've talked about the tourism heading down there. And then, as it being landlocked as a location is pretty good place for investors to sort of tap into.
And what about we touched on, Kieran, the regional there. You touched on the fact that you should be wary of the one horse towns. But is there other parts of the regional New Zealand we should look into?
you look at where people are going to, right? So,
Yeah.
I mean, Tauranga is another example where we know there's sort of a flock of Aucklanders seem to head down there in their retirement. So there's a constant, undertow to increasing the population. So, you look for things like that. What's actually attracting people to the area? Are there jobs? Is it a lifestyle choice? And that's really what drives, value growth over the long term.
What about Christchurch and in the areas around Christchurch? Pegasus. What's happening with Pegasus?
Yeah.
This is your retirement plan, though, isn't
Pegasus.
it? You just want to move into Richard Hadley's house at Pegasus.
Christchurch has had a significant building boom as a result. I mean, after the earthquake, of course. So, but really, it's been through a significant growth phase, and I think there's a bit of a consolidation, to be fair, coming. And there's a lot of development of specific types of property as well.
Yes.
So there could. I'm not saying there's an oversupply, but if they keep building at the rate they are, there possibly will be.
Yeah.
Yeah, there seems to be a whole lot of townhouses being built down there.
Yeah, well, that's a good point. What to buy now? Like you've just explained where and what to look out for and signs of growth and the infrastructure side of things. What do you buy? Obviously, you've definitely steered us away from the villa, and Matt Heath will steer you away from the villa/bungalow. So what is a standalone house better than a townhouse or an apartment, Kieran? What?
It really depends on on your desired outcome. At the moment, if you look at a townhouse versus an existing unit sitting next door, I mean, the prices are quite similar, but the townhouse is appealing brand new because you've got low or no maintenance for the first 5 or 10 years.
So So go back. What townhouse? What is a townhouse like? Describe it. Is it
okay? A townhouse
is it a standalone?
No,
No.
typically not. No, they're not a standalone. It'll be a townhouse is when you have a block of maybe 4. They're all joined.
Yes.
Looks like, I won't say a sausage block because they're quite
and it's
clever.
got I know what you mean. Yeah,
Yeah,
so they're
so-
all joined up together. You've
Correct.
got a small
And as
backyard.
opposed to an apartment, your door opens onto the ground level. You've got multiple levels, and
I mean, apartment living suits some people, but you really want to appeal to tenants that are prepared to pay a bit of a premium. And if you look at a brand new build versus the older unit next door,
Yes.
which one's going to rent? Which one's going to attract the most potential tenants? And is it going to get a premium of rent? Well, obviously, the new build gives you that advantage. Also, a new build, you can borrow more from the bank.
Yeah.
So as an investor.
Yeah.
So if I buy the unit in the sausage block next door, I'm gonna need to put more money in or use more of my equity versus buying that brand new build.
Yeah.
Yeah.
So new builds have a lot of advantages at the moment, those townhouses. And of course, if you want to buy a house, well, it's a question of what can you afford to borrow, because the entry price is going to be a lot higher because of the potential value of the land.
Yeah.
Have those townhouses changed the game for investors, Liam? We've seen them going up everywhere. Have they changed the game?
Yeah, I think. Well, they provide I think as Kieran said, an affordable entry point to property investment. So you're getting, as a townhouses, it's generally over multiple levels, 2 or 3 levels, and it does, balance. You're generally getting something that's new build. It's got rental demand there, and provides a good yield, a balance of yield and sort of purchase price there. So they're a great option for investors as well as first home buyers.
Sweet. Kieran, what's the difference in long-term returns between a house on its own land and a townhouse in a development?
Yeah, well, the first thing to think about is, to understand is that not all houses are equal. So I could look at 2 houses on a street next door to each other that look similar and on the same size section. One of them has great development potential and the other one doesn't. It's on a deep flood zone, for example. So suddenly, they're completely different. They have completely different values. So for the untrained eye, that's a bit of an issue.
Yeah.
Because one of them is going to sell for a massive premium and the other one isn't, because of that future potential. So that's the first thing. You need to be very wary. You need to do your homework before you make that step. And you'll get less cash flow. So, I could buy that one house or I can buy 2 or 3 townhouses next door. So which one do I want to actually own? One of them is going to give me a heck of a lot more cash flow. It's still going to get capital growth because everything's relative. If the house goes up by 50%, the townhouses are going to go up eventually. Usually the houses go up first, but the townhouses will catch up. Otherwise, I should be able to go and buy a an apartment and a unit in Mount Eden for a couple of $100,000, but I can't because everything is actually relative. So if you need more cash flow, which most investors actually run low on cash flow is actually really hard to achieve. Capital growth is kind of a given, but cash flow is crucial. So I think that's why I think at the moment you're better to buy a townhouse than you are to a couple of townhouses than a house.
So when you speak of cash flow, I mean, cash flow involves having tenants in the house. So how do you know a property's going to be the right property to attract the tenants that are going to A, want to live there, and B, pay their rent and not cause you a whole lot of problems?
Right. Well, typically family tenants are attractive because they seem to have more sort of commitment to staying longer in an area. So you want to look at school zones. That's what attracts people.
Yeah.
I mean, you could take for example, the double grammar zone in Auckland, and that attracts a lot of people. And it's locked. There's only a certain amount of area that you can actually live in to get your kids into the school. But you've got to pay a massive premium to buy there. But the rent is also a little bit higher than you would get. But so school zones, infrastructure again, shopping malls, jobs, transport links, all of those. It just keeps coming back to the same things. If you've got to go to areas that are actually offering that. If it's out on a bit of a limb and doesn't really have much to offer, then that's a bit of a challenge for potentially getting tenants. You want a property that's going to potentially attract the maximum amount of people, so that then you can cherry pick the people that you actually want. So if you want the best, you need to attract as many as you can, and then filter them.
Makes sense, eh? Liam, is it smarter to buy one like high value property or two smaller ones?
Yeah, so I guess with if you're going to split it into two properties, it sort of taps in the point of increasing cash flow. So if you got, for example, $1.4 million to spend, the yield you might get on a $1.4 million property might sort of be that $800-900 a week. Versus you spread that across two properties, you get a bit more liquidity there. So you can sell one of them at one point. You spread your risk, and then your cash flow might increase to sort of $650 across those two properties. In most cases that might be more beneficial for someone.
Okay, sweet. Let's move into the kind of risk side of it, and something that we're probably the worst at in terms of risk assessment and looking at the risks and not taking them. What's the most common thing people forget before buying a property, Liam?
Yeah, one of the most common, and I think we tapped on it here, is they kind of neglect the net yield. So quite often you could see a property, it's worth $800K and it rents for $700, but you're kind of forgetting all the other costs that can come into owning it. Your insurance, your rates, your maintenance costs, and that can, for example, Wellington, the insurance costs down there and rates are quite substantial, so that can impact your yield quite drastically there. So that's one thing, is people neglecting the net yield. Other things is they might not have considered, if it's an existing property, what's involved with owning that, and those unexpected costs that can come up, like body corp fees and stuff like that. Is that something you need to look at? Yeah, exactly, and that's something that's really important because they can be quite complicated for the first-time investor. And that's where we can come in. We see a lot of body corps. We're generally looking for, for an investor, you don't want a body corp that's covering swimming pools and lots of high-cost things.
Right.
Because, that's maybe something that, Matt, you might want that in a tennis court or, that apartment complex. But
sauna.
Yeah, saunas. But those
things. It's very spa and sauna focused, Matt Heath. So
absolutely.
He would pay a premium.
But what you don't want is a poorly looked after pool, spa or sauna communal area that you stop going to because it's terrible or it's dated or whatever, right?
Yeah, exactly. So it's important you know what you're looking for, and that's
because a lot of that looks good in those sort of 3D fly through.
Everyone's
going to be everyone's going to be in their bikinis in the pool, and there's going to be
utopia.
Cocktails at the communal area. Everyone's in the sauna making business deals, and then the actuality is not so great.
Kieran, you're very infrastructure focused, but you're a details man, which is great, and great to have you on your side if you're working with Staircase, to have you and your knowledge. How do you find out if a property's in a flood zone or if it's in an earthquake risk zone, or is that risk at all?
It's actually really simple. Like, you put the address into Google and put next to it the words flood maps. Google it, and it'll come up with the council website flood maps. You can go into the council website, and that actually shows you precisely. So you can put the address of the property, and it shows you, really simply, a map with, the blue water on it.
Yeah.
And you're in a flood zone. It's not actually that complicated.
Is that it?
That's as simple as that. Lim report will also do the same. That's, if you're seriously interested in the property, a lim report's definitely required.
Yeah.
That will do it as well. But yeah, you'd be surprised how much information you can get from the website, from the council websites. They have these layers that you just click on, and it will show you.
And earthquakes as well? Do they have the same kind of
the
vibe?
lim report.
Lim report has that?
Well, yeah. I mean, we all know that Auckland's relatively. Yeah, I think it's not that complicated about an earthquake because I mean, if you're buying in Christchurch, is there going to be an earthquake? Well, there's
Most
one
likely.
recently.
Wellington,
could be.
yes.
Wellington could be, but Auckland lesser. I mean, you've only got to look at the fact that insurance premiums reflect that risk as well. So you could actually, if you really want, you could get an insurance quote on the property before you buy it.
Yeah.
And that will actually give you some indication probably of, what the risk is, because the higher that quote is, the more risk it's going to be.
Yeah, right. But that's something you guys help with at Staircase, isn't it? You help guide people through all that.
We do a lot of the due diligence
Yeah.
for our clients.
Yes, you don't know. Now you're talking.
We're kind of a bit like a bodyguard to protect them from, getting beaten up by a deal.
Yeah.
Yeah.
School zones, school zones, you were saying before, school zones are still really important, are they? Because, and how do you know, like, say, for example, you mentioned grammar zone before, right? But everyone wants their kids to go to Mags now. Mount Albert Grammar's much better school than Auckland Grammar. Auckland Grammar's
You're massively biased, though.
You don't live there, do you?
Mags is a great school. That is a far superior school to anything else in Auckland. So the fact that people would pay extra to be in the grammar zone, come over the other side of Eden Park. That's where the action's at.
Does the decile rating matter? Because remember the old deciles, like decile
that's
1
not
to
still
10?
going,
is
is
that still a thing?
Yeah, the higher the decile rating, probably the more people you're going to want to be living in that location. But
You don't want your kids going to Western Springs. That's the key.
well, no, it equally applies to other schools as well. I mean, it all comes back from our perspective. It's all about investing, and it's all about attracting the maximum amount of people potentially to rent your property. That's what it keeps boiling back down to. This is why the infrastructure, the school zone, the population growth, that growth will come if you've got that in place.
Yeah.
And Liam, how do you, looking at a developer, so you're saying the new build's the way to go. You probably best to get an early buy off plans. You guys would recommend that. How do you do your research on your developer? Because you hear horror stories of developers going under. Herald love writing a headline of a developer going under.
Yeah, they do.
And how do you guys help with that then?
Yeah, I mean, not every developer is the same. I think it's important to look at, the track record of a developer. So if they've been around for a while, they've probably got a few projects that they've completed. So you can generally, see the quality of those projects and how they've delivered them. If they're in it for the long haul, so there's quite a few developers out there just to make a sort of quick buck and put up a few townhouses here and there, but and those might not appear to be the best deal. So if you're finding a developer that is in it for the long haul, those warranties that you look after, they're going to be intact. And then also just checking maybe how they are funded. A lot of this is something that maybe behind the scenes that we can take care of, looking at, hey, as a developer, well, how are they funded? What's their track record? And over the 23 years, we've built really good relationships with these developers. So, quite often we've got a bit of leverage with them because it can be quite difficult if you're a solo purchaser to go up against a developer to try and get things up.
Right, yeah.
So we have, a lot of that experience. We've got that legal backing with developers so we can, bat in your corner to make sure that, you do get something that's built to your expectations are met and, you can go into it really confident, right?
We also have a due diligence checklist against the developers, which is a couple of 100 points that we actually go through with a fine-tooth comb. Yeah. So we're really interested in protecting our clients from any potential drama around that issue.
Well, totally, because it's the last thing you guys want.
Yeah,
isn't it? Yeah. So it's
well, when clients are buying off us, they're actually buying through us, but off us. So they're not actually buying from the developer. So if the developer got into difficulty halfway through the process, we're going to step in and be involved in helping our client through that process rather than they're on their own trying to fight the developer.
Yeah, I mean that's what terrifies people a little bit, isn't it?
Oh, absolutely.
Because there's so many variables in that space.
And no one hears the good stories, do they? You know what I mean? Like, there's not a headline in the Herald of a good story.
The good story is someone just goes home to the house, they're happy, and the house is rented, and no one ever hears about it.
Yeah, exactly, and especially buying off the plan. So we've had situations in the past where a client has bought something off the plans, and their situation's changed leading up to settlement. I think one situation they lost their job or their income went down. And in most cases with that developer, you might lose your deposit in that situation. But, in that situation, we were able to move them to another project.
Right.
So we've been able to step in and things like that to sort of help the client see it through. And that's something we're pretty proud of.
Back to Mr. Infrastructure, Kieran. Council plans and zoning changes, like what should investors pay attention to?
Yeah, they're critical. I mean, you can think about the Auckland Unitary Plan, which made a big difference to...
What is that?
What is the Unitary Plan?
I hear a lot about the Unitary Plan as
is it unifying
the
Middle East. What is it?
Unitary?
Basically, it was an upzoning plan for Auckland because...
Sounds like a religious organisation.
The council realised, well, might be if you
dig deep enough.
The Church of Property Investment. But basically, the council was aware, Auckland Council was aware that we need to build up and more. We need to get more properties on the existing land because if you have a whole lot of houses sitting on large bits of land, then you have to start building on the outskirts of the city, which is very intensive in respect of you've got to build a road, you've got to put in brand new stuff. So the infrastructure cost of that is significant. So what they did is they upzoned a large portion of Auckland. So give you one example, a property in Henderson that could previously be subdivided into 2 sites and take 2 houses. Maybe it only had 1 on it, but you could split into 2. Well, under the Unitary Plan, they basically said, well, you can put 6 on there now. So that's what the Unitary Plan did, is it allowed for hundreds of thousands of extra houses to be built on existing land, which was really good for the Auckland property market. It actually reduced, believe it or not, reduced the price of a property because it reduced the size of the land down. That's why you can buy brand new townhouses for $600,000-$700,000. Otherwise, if we hadn't had the Unitary Plan, we would not be where we are today. Property wouldn't be as affordable as it is today.
Liam, what's the difference between a good deal and a stinker? And a stink deal when it comes to property investing?
Yeah. Well, a good deal to someone might not be a good deal to another person. So, for example, if you're someone, if you're a builder and you're wanting to add value to a property, you've probably got a bit more time on your hands. So you could find an existing build and add value or renovate it.
Yeah.
For a lot of our clients, they're quite time poor. They don't have the time or energy, and they don't have the buffer of an experience to go and do that to a project.
Yeah.
So, for them, it's more like a new build seems to be the approach that they typically take.
Yeah. Minimum fuss.
Yeah. So it's kind of trying to figure out what is your strategy in place for property investment, and then which pathway is gonna fit you the best. Yeah. And again comes back to the looking at the due diligence of that property and how it actually stacks up, and making sure you run those numbers.
So, looking at due diligence, then staying with you, Liam, can you realistically do it yourselves? Could Matt and I do it, or is it best to have a team? Because I'm leaning on the team thing, looking at our track record. Yeah.
Well, I guess, there's certainly a lot you can do. I just, the main thing is just knowing what to look for.
Yeah.
And, just because when we've done this for so long, we know exactly what a good deal looks like. We know how to, how to do that research on a property. So you guys can go into it knowing that everything's been covered. All the boxes have been ticked. So there's no surprises on the other side of it when you own this property.
Kieran, what's something that you just immediately, you're doing the due diligence and you throw your hands up and you're like, we're out. This is just red flag.
What, the one thing? The one thing is a myriad of things.
Yeah.
Because there's so many, unfortunately.
Yeah.
I'll give you one example. Okay, so this is a real life example of 20 years ago. There was a new building built down on the waterfront of Auckland CBD. And you could, for $600,000 back then, 20 years ago, just think about that for a moment, you could buy a brand new 2-bedroom, generous floor size, double car park in the building, sea view, fantastic, rent really good, all the numbers looked fantastic, a lot of investors at the time bought them. I was telling my clients at the time, don't go near it because there was a problem with it. And I'll tell you what the problem is in a moment. But if you want to buy that property today, 20 years later, they're actually selling for as low as $30,000. Your $600,000 has evaporated into $30,000 today. The reason for that is it's leasehold land. So today the ground rent, because it's gone up so much, chews up all of your rent. So you've got nothing to pay a mortgage. So why would you borrow money to buy it when you can't actually pay for it? So that is a classic example, a leasehold property. You have to look very carefully at, that's just one fish hook that can catch you. It looked really good on the front, the numbers looked fantastic. But today, it's a nightmare.
So you don't really own, if you buy a leasehold property, you don't really own the property.
Technically, you own the building that's defined by your little slice, but you don't own any of the land, so you have to rent it.
Right, and that can change. That can change at any point.
Well, the land value goes up, and the rent is actually tied to the land value, so you're left behind all the time. But that's just one example. I mean, there are so many things. The floods are, you really need to do your due diligence.
So, Liam, it's all about due diligence, is it?
Yeah, I think it's important not to overcomplicate it. I think we have, we can tick a few boxes. We can make sure that we cover all the bases on a property.
That's why you guys exist, though.
Yeah. I know we've talked about quite a few things here today, but it's just, streamlining it down to the key things for a property and making sure you got those covered. So you can sort of, go into it pretty confidently, and that's exactly what we do.
Right. Okay. Are you down with this, Matt? Are you ready to do some due diligence?
I'd be keen to get someone else to do some due diligence, but that's a type of due diligence, isn't it? Like if you do your due diligence on the people you're going to get to do the due diligence,
and
that's sort of outsourcing your due diligence.
And I feel like currently we're doing our due diligence on Staircase at the moment through these episodes on property investment.
Absolutely.
Which means we'll wrap this one up and we'll come back with our final episode, and that is the action plan, Matt. That is putting all of this into action.
All right, action-packed action coming up.
The Alternative Commentary Collective presents the Alternative Guide to Everything You Need to Know About Everything You Should Know About.